Just how dangerously overvalued is today's stock market? Well, here's what highly respected economic analyst Stephanie Pomboy thinks.
Without trying to sound hyperbolic, I would say that in the 30 years I've been doing this, been in the business, and the 19 years I've been doing my macro maven shtick, I've never seen a situation where the markets were farther afield from the economic reality on the ground than they are today.
Welcome to Peak Prosperity. This is Adam Taggart, co-founder of peakprosperity.com, welcoming you back for another week of making sense of money and the markets. And today we have an absolutely excellent guest. We're joined by Stephanie Pomboy, who is the founder of the economic research Macro Mavens. Stephanie is one of the most widely respected women in all of finance. Her clients include the largest U.S. mutual funds, investment management firms, and global hedge funds. You frequently see her in the major media outlets like Bloomberg, Wall Street Journal, Barron's, CBS Market Watch, New York Magazine, etc. Stephanie, thank you so much for taking time out of your busy schedule to join us today.
Well, thank you for having me. It's long overdue, but I'm happy to be here with you.
Thank you. It's an absolute privilege. And look, Stephanie, I'm particularly excited to talk to you about your outlook for the road ahead for investors and the economy. But before we drill into those details, can I just ask you to sort of summarize your general opinion of the current status of the economy and the financial markets today?
Well, I guess without trying to sound hyperbolic, I would say that in the 30 years I've been doing this, been in the business, and the 19 years I've been doing my macro maven shtick, I've never seen a situation where the markets were farther afield from the economic reality on the ground than they are today. People talk about the markets shrewdly discounting this V-shaped rebound that we're going to have once the lockdowns end and we can get back to life as we knew it before coronavirus. But given the fact that we've added some 5 trillion almost in market cap from where we were before we even knew what coronavirus was, I think the markets are clearly not discounting a return to where we were. They're discounting a return to some kind of fantasy land where everything's all gumdrops and roses, and maybe we're all taking rocket ships to Mars. I have no idea what they're discounting, but it's not anything that I see on the horizon. People talk about that market cap to GDP measure and use that as a pretty simple yardstick. And if you look at the historic relationship, the market cap is normally traded at 80% of GDP. So we're at, call it roughly 20 trillion in GDP. That implies the market cap should be 16 trillion. Today, the market cap is over 40 trillion. So we need GDP to more than double tomorrow just to justify the levels to which the markets have climbed right now. So suffice to say, I think that the markets are well ahead of themselves, and this could create some really large risks, but also some great opportunities for people who keep their powder dry.
All right, great. Well, I'd love to get into both those risks and opportunities coming up here. So thank you for such a great distillation of where things are. I want to speak to some comments that we kind of get regularly in our comment section to these YouTube videos where people accuse me of bringing in only bearish analysts. And I just want to say, I like to start these interviews by asking that question before, introducing any potential biases. Because I listen to what you say, Stephanie, and it's very similar to what a lot of the other experts of your high level of esteem have been brought on to that we brought onto this program in the past 6 months or so. And I don't see these people as bearish. I'm not picking them because they're bearish. I'm picking them because they have decades long experience in tracking the markets in economic analysis. And I just see them as practical analysts who are looking at the data and reporting at what they see. So just to give you the opportunity to let folks know whether you're a perma bear or not, did I summarize correctly that you're just being a pragmatic analyst here?
Absolutely. And I like to think that there's value in highlighting the risks that other people aren't seeing. So whether you want to call me a perma bear or not, I do approach the markets with a very antagonistic view in that whatever the markets are already discounting, everyone's aware of that. That's not interesting. If I come out and tell you we're going to have a V-shaped recovery, I'm not adding any value to the discussion because that's already fully reflected in market prices. Let's talk about what the risks are and where the unseen dangers to that outlook arise and try to figure out ways that we can navigate around those. That's really what I'm interested in talking about, is what isn't priced into the markets, and what are the probabilities that some of those risks actually materialize.
Great. And you're exactly the type of person that we like having on this program, because we do like to think that this is sort of a thinking person's program, right? That we're asking lots of critical questions about the generally accepted narrative, and then helping people find pockets of risks and opportunities, as you just said. So all right. So building on from there, Stephanie. As I said earlier, like you, a lot of the experts that we've had on this program recently are very concerned about the high level of distortion that market prices have reached today. I mean, really kind of their most ever gap between market pricing levels of valuation and the underlying economic fundamentals. And we're also seeing those same experts become more and more concerned about higher inflation going forward. Given both what we've seen happen over the past 12 months, where central banks and governments around the world have flooded the world with more trillions in monetary stimulus than ever before by a long shot, by a huge factor. And then secondly, just listen to what the central banks are saying, right? The Fed is telling us that it's actually willing to let inflation, quote unquote, run hot for a while, right? So there seems to be a growing consensus, at least of the experts that we've had on here, that we are exiting an era of secular deflation and entering an era of secular inflation, which requires a different playbook. And there's not a lot of people alive today who have practical professional experience investing in an inflationary environment, just because we haven't lived in one for such a long time. Reading some of your recent stuff, it seems that you have perhaps a more nuanced view on the inflation story, that there's parts of it you agree with, parts of it you may not. Can you just share for our viewers what your perspective is?
Sure. I find a lot of the inflation arguments very compelling. Obviously, we have a real decline in the dollar. We've got unprecedented monetary and fiscal stimulus. And as you said, the Fed is basically welcoming, waiting to see the whites of inflation's eyes. And then, as I like to say, promising to wait till it's full frontal before they do anything about it. So that's, you don't want to bet against the Fed in that regard. And you also, against that, have a secular shift, I would argue, away from globalization towards a more isolationist policy, or you did, at least during that whole trade war situation under Trump, where he was, really renegotiating trade deals far and wide and looking to make domestic manufacturing perhaps more economic than offshoring. And that's sort of a shift in that whole trend toward globalization, which itself ushered in this great era of disinflation, because suddenly you had to compete with cheap Chinese goods and things made in Vietnam, et cetera. So that was a massive force for the disinflation we've seen over the last several years. And that seems like it could be drawing to a close. But from a secular standpoint, I think the two largest forces for deflation are still out there, and they're even more powerful than they were before. And those are debt and demographics. In the US, obviously, the debt situation post-pandemic has only gotten much, much worse. The burden of trying to service this enormous debt burden, not just on the part of the government, but look at our corporate sector that's just got sclerotic amounts of debt on their balance sheets. And while everyone talks about how they've been able to refi at these incredible low rates, if you go in and you look at interest expense for the corporate sector, it really hasn't come down very much from its all-time record highs. So despite the fact that they have this opportunity to refinance and roll paper, and they're doing that, they're increasing their total debt so much that the debt service isn't coming down at all. So we still have a major problem in that we can't handle any increase in interest rates, because the debt service would just destroy the economy. It would just suffocate the entire economy, both in the government sector and the corporate sector, and obviously the low-end consumers who have to borrow just to sustain a lifestyle. So that's a major force for deflation that's even more powerful today. And then on the demographic front, I think this is where the Fed went awry with the whole QE strategy to begin with. And that is the idea of taking interest rates to zero was supposed to incent risk taking and get people basically, for lack of better alternatives, to throw money at risky ventures, which would then get the corporate sector, let's say, running out there and expanding production and hiring. So the idea was that for a little while, we'll misallocate capital, but ultimately we'll create a lot of jobs, and then things will be able to normalize because wage growth will increase and consumers will have the income with which to support this increase in debt. The little wrinkle that the Fed failed to contemplate was that pushing interest rates to zero on a population that's young is one thing. Pushing rates to zero on a population that's nearing or in retirement is an entirely different animal. And what's happened is that those people who are in their late 50s, early 60s can't afford to retire when there's no miracle of compounding on their savings. So not only are they struggling to set aside enough money just as it is, but they're not getting the benefit of any compounding on that. So they have to save twice, 3 times, 4 times as hard if they want to retire at 65 or whatever age they had planned on. So perversely, and I like to describe this, I don't know if any of your viewers are Seinfeld aficionados, but I think of George Costanza and how he comes to the epiphany that his life is the opposite of everything he ever intended it to be. And I joke facetiously, but it's really true. If you look at the QE policy, its outcome has been the exact opposite of everything the Fed intended. It hasn't increased consumer spending. It's increased consumer saving. It hasn't increased inflation. It's fed the forces of disinflation by sustaining zombie businesses that are margin killers across industry after industry. So the policy has been an unmitigated disaster. Doing more of it isn't going to create a different result. It's just going to intensify the same problem, in my view. So those are the reasons why secularly I still believe in deflation. Separate from that, I do think we could have an inflation scare in the short term, but that's really a mathematical year-on-year situation, but it's not a longer-term scenario.
All right. Well, that was such a great answer. And there are several threads I'm just really excited to pull on in there. But I just got to give you kudos. I love the George Costanza analogy. And you pair that, with the Fed basically realizing the exact opposite outcomes that it apparently wants to be achieving here with, just the Fed's own predictions about where its own interest rates are going to be and things like that. And they never, ever hit their targets. And so it does sort of beg the question, why do we even listen to these guys anymore? Right. They basically are the most powerful entity in the world when you think about the influence their actions have. And yet these guys are, in many ways, the gang that can't shoot straight. Like, how do we let these guys keep the job? It's crazy. All right. So there's just such great points you made. Let's start with the demographics part first. I'm gonna throw a question at you that I don't know the answer to. I don't expect you to, but I would love to hear your answer to it, which is, why are there not armies of seniors out there, with their torches and pitchforks, storming the Federal Reserve, right? I mean, the Federal Reserve has killed not only the incentive to save, but it's killed retirees. You used to basically plan to retire on a fixed income, and now you can't get anything, right? To get any kind of risk, you have to go so unacceptably far up the risk curve now. So, I think if you look at the numbers, there's really only like a third of people of retirement age who really have any sort of sufficient savings at all, and they're not getting a lot off of it. And then, of course, everybody else who's got a little bit saved up is getting absolutely squat. So, Stephanie, why are there not hordes of angry seniors out there holding the Fed accountable for throwing them under the bus?
Well, I like to facetiously say that it's nap time at the AARP because they clearly have not gotten onto this at all. But seriously, I think one answer came down from the St. Louis Fed a couple of weeks ago. They did one of their usual bang up analyses, and they went back and looked at employment growth from 2000 to 2020, so the 2 decades before the pandemic. And they actually found, and this is hardly a revelation because you could look at this data and figure it out yourself, but it took them 20 years to do the math, that 101% of the 11 million increase in employment over that 2-decade period was people 60 years and older. So they don't have time to go down and picket Washington. They're at work because they've got to set aside enough money to save for that rainy day. They can't leave the workforce. And if you look at the labor force to participation ratio of people 65 and older, it's the highest it's been in 60 years. So these people, they're acting. They don't, I guess facetiously, I would say they don't have time to go and picket because they're literally trying to put food on the table still. But I think this will blow back. This is what I worry about when we have that resolution of the gap between asset prices and reality, which I believe we will actually have. The Fed can try to prevent that day from coming as long as they want, but they can't really prevent it. Ultimately, we're going to see the fundamentals reassert. I believe, I can't abandon hope for that. But what worries me about it is not what's going to happen to the Robinhood people or some wealthy hedge funds. It's that it's going to completely decimate the pension system in this country. U.S. public and private pensions combined are $6 trillion underfunded today, with the markets hitting all-time highs and junk yields under 4%. We've never seen a financial mania like this before, and yet pension funds are running the largest deficits in the history of mankind. When we went through the dot-com bubble, and then again when we had the housing bubble bust and the global financial crisis that followed, those pension deficits doubled on average. So we could be at 12 trillion overnight in terms of a shortfall. What does the government do about that? They can't say, hey, we're going to bail out Wall Street, but we're going to let these poor pensioners not have any money for their retirement. So whatever money printing we're seeing right now and COVID stimulus is just
a warm-up game.
It's a drop in the bucket. I mean, this is nothing compared to what happens if this market comes unglued, which I guess will be a reason why the Fed is just going to have to keep huffing and puffing and doing everything it can to try to keep this game going as long as possible.
God, Stephanie, so many great parts of this conversation. I hope you've got 3 hours to park it because we're.
I'll make a margarita and we can be here all night.
All right, great. Get the blender spun up here. So quickly on the pensions, we had Ted Seidel, who is the recipient of the largest whistleblower award for pension fraud. We had him on probably about 6 months or so ago. Really fascinating interview, folks. If you haven't seen that yet, I'll put up a little note here for it. But he echoes everything that you just said, Stephanie, in terms of how just poorly managed so many of these pensions are and how they're just literally hanging on by their fingernails in the best market environment of all time, right? And so we get any sort of correction here, the cascade of failures is going to be just truly epic, right? So you talk about, your fear about, of all the different demographic classes damaged, it's going to be those who don't have the time to recover from that are going to be hit the most, and that is the elderly. So there's that to worry about. One other issue on pensions, just a flag here, because I find myself talking about this more and more. In a zero interest rate environment, if you worked in the private sector, your neighbor worked in the pension in the public sector and has a pension, let's assume for a moment that their pension is $100,000 or $200,000. That's a pretty healthy pension, but there are a lot of people that get pensions like that or more, believe it or not. That's the equivalent of having like tens of millions of dollars in the bank in this type of zero interest rate environment, right? So having a pension is an unbelievably valuable advantage in today's environment. And so we're having the kind of this class schism between private and public workers, where, the private worker has said, look, I worked my butt off, and I tried to save as much as I could. But even if I saved a couple of $1 million, which is quote unquote winning the game, you're not really getting anything off of that in terms of an income that can support you in your twilight years. Whereas somebody who worked a government job, and I'm not going to get into if one job's cushier than the other or whatnot, right, but that person with a public pension, it's like they have tens of millions of dollars. And so especially when, taxes are going to pay for pensions and whatnot, there's just this growing resentment that I can see and feel in society between this right now. And that's going to have to resolve some way. And it's going to either resolve, I think, with the pensions breaking and the public pensioners finding out that, hey, you're going to get a lot less than you were promised, right, which is its own set of unfairness and pain, or it's going to be the private sector people saying, there's no way that I'm letting my taxes go to, fund these anymore. And you're going to have some real heavy class friction there. So curious to hear your thoughts on that.
Yeah, no, I agree with you 100%. I guess I think of it from just a macro standpoint. As you were talking about it, I was just imagining how much weaker would consumer spending be if those public sector workers didn't have that kind of warm security blanket of knowing that retirement money is going to be there. Presumably their behavior would be modeled much closer to the private sector folks who are doubtless the ones who are scrimping and saving and trying to set aside enough for the rainy day that no one else is setting aside for them. So, that's a really interesting discussion in terms of what happens as those pensions get renegotiated, because when I go around and I spin my astonishing tales of pension doom to the major institutions, they all kind of look at me and say, this pension thing's been around forever and it's never an issue. And the way we're going to get out of it is they're just going to renegotiate all this stuff. And as if that will have no impact. And I keep saying, well, okay, fine. You're going to take the pension away from, or cut in half the benefits you're providing someone. Do you not think that's going to be reflected in their behavior in terms of spending and saving? It sort of brings me back to this chart I do that shows household financial net worth relative to savings. And you have never seen a situation like we're in today where net worth has just made this asymptotic rise on the back of this massive financial asset bubble. And yet saving rate has gone up alongside it. Ever since Greenspan was installed as the head of the Federal Reserve in '86, he basically persuaded the populace that you didn't need to save out of income like your grandparents did. You just rely on your IRA or your home. Your assets will do your saving for you. You can trust that your assets are always going to be higher and higher. He even made famously the comment that home prices never go down on a national level. And therefore you should, be very aggressive in owning real estate. And then of course, we established the Greenspan put under the stock market, and we're living with the consequences of that today. So it's amazing to see this shift where, despite this tremendous financial asset inflation, people have become distrustful of that assets will be there for them at the end of the day. And no wonder, they lived through the dot-com bust, they lived through the housing bubble bust, and now they're actually saving the old-fashioned way. So again, it brings me back to that question of what happens when or if the stock market actually does return to some normal valuation. How intense will the saving pressure be then? I mean, obviously it'll be substantially higher than it is now with all the negative impact on the economy.
Well, let's talk about that. God, just really quickly before we do, I do want to touch on your debt part of the deflation story.
Oh, yeah.
Just to get these two thoughts out there, but I really do want to get to the market repricing itself, which I think is a polite way of saying this market may correct really hard. But on the debt side, you talked about how companies have been levering up because interest rates are so cheap, and they've been livering up to the amount that their interest expense hasn't really changed all that much, right? And what they've been doing with a lot of that debt that they've been taking on has not been really putting it to productive growth as much as they've been buying back their shares, right? I mean, it's really just sort of an accounting process, and really one that just sort of enriches and favors existing shareholders, right? So in some ways you can make the argument that we are creating these zombie companies that are have much more leverage than they did in the past, but not a lot more economic health. And that if we get into a point where either the economy falls further into recession or interest rates go up, we could just have this cascading collapse of all these zombie companies, because they're not going to be able to afford their interest payments. We are beginning to see interest rates creep up a little bit, right? The 10 years now at almost 1.3. What people forget, or I don't know if they forget, but they don't spend a lot of time thinking about, is that's the safest debt that's out there, is treasury debt, right? So all other debt rates are going to be higher than what the treasuries are. So if we do enter a world where rates continue creeping up higher, we have got this massive flock of zombie companies in corporate America that are just going to start dying on the vine the higher those rates go. So I'm sure we could talk about that forever, but I just wanted to flag that for folks, because that is it's basically just like dry tinder that's waiting for the match, right? And
Can I add a little extra
Absolutely.
tinder to that fire? The top 3 companies in the S&P have more cash than the bottom 400. So that just illustrates that the idea that they can manage an increase in debt service is completely pie in the sky. That's the top 500 companies. Those are the largest companies in the US, much less the zombie companies you're talking about. A lot of them are well below that top 500 companies. They have zero cash on their balance sheets, so they can't handle any kind of increase in debt service whatsoever. But I just figured I'd throw that on the fire for you.
No, great point. I'm glad you did. It's a great segue to my next question, which part one of that question will be, go ahead and tell us, what you think about the likelihood of the market remaining at these heights or having a big repricing, and how big you think that repricing could be. In the past, we've talked about Jeremy Grantham's recent call, just saying, hey, look, if you look at history, you see a 50% plus correction when you see the type of setup we have in the markets right now. We had David Hunter on a little bit before then, who was calling for a 65 to 80% correction this year. While that seems really high, it wouldn't be necessarily unprecedented, though it would be incredibly painful. But I want to just build off of your comment there about the 4 companies having more than the bottom 400 or whatever it was, because it ties to the question I really want to dig into you here, which is, I think it's something like the top 3 richest people in America own more wealth than the bottom 50%, right? So we're seeing just tremendous wealth inequality in this country, right? And if you look at, our policy choices when post-pandemic, right? We had a bunch of options on the table we could have picked. We picked a certain set of options, and you and I could have had a really heated discussion about how bad wealth equality was before anybody had heard the word coronavirus, right? Now, when you look, I'm going to put up a chart here. The choices that we made, just the results, I won't call it good or bad, but the choices that we made basically added $4 trillion worth of wealth to the world's billionaire class, and has taken almost $4 trillion worth of wealth from the world's working classes. So we picked a set of policies that basically said, okay, there's a global pandemic, things are getting upended. Let's make sure that we take the pie and distribute even more of it to the wealthy people and away from the other people here, right? So where I'm going with on this is, most of our viewers and most of the experts we've had on here, I think, are kind of wrestling with this increasingly kind of binary set of outcomes going forward. One is that we have some really big repricing of the markets, right? 50% plus, let's say. That's still very painful for a lot of people, right? It wrecks portfolios, it wrecks incomes, it wrecks jobs. Nobody escapes that without feeling a good deal of pain, right? But maybe it gets rid of a lot of the excesses, and maybe we rebuild from a smarter baseline after that. So that's path A. Path B is we just sort of continue going where we're going, where the melt up continues, price of living continues increasing, maybe inflation's, coming into the mix here. And that wealth inequality just keeps growing and growing and growing until we are essentially a nation of the 1% of elites and the 99% that just lives in serfdom to them. So it's very grim binary choice, I admit. Yeah. But looking at that, do you put probabilities on that? It sounds like you think that there is a market correction in our future, so maybe there's more probability on your end on point A. But at a higher level, is that sort of how you see it too, or is there kind of a third or fourth option that might be a little bit nicer that I'm just not picturing?
No, I mean, unfortunately, I don't see that there is a nice option. I wish I did. So I think the way you described it seems really well articulated to me. The only other option that I could envision, and I can't fully envision it or articulate it, but it would be one in which those outcomes would be somehow forestalled by actions by China that it undertakes to sort of reassert its own dominance in the world order, which I think it's already trying to make moves in that direction while the rest of the world is on its heels battling this coronavirus. They're doing a lot of things behind the scenes in their own economy to sort of position themselves as the number one superpower. And I don't know, could they come in and say, look, we demand gold in exchange for the debt that the money you owe us. I don't know. I'm just throwing that out there as a possible third avenue that could suddenly be a fly in the works in the interim. But in terms of things I can actually fathom and articulate, let's get to things I can actually comment on coherently. I guess the optimist in me, and that'll sound really dark, but of those two scenarios that you outlined, the optimist in me thinks that we would have that reversion to the mean in terms of asset prices sooner rather than later. And I guess I can string together a scenario where that happens based on that inflation scare that I think could very well materialize, even though, as I described it in gory detail, I believe deflation is still the winning hand. In the near term, we do have these easy year-on-year comparisons with the lockdown of last year, where we had, there was no demand for any commodities or anything whatsoever. So mathematically, you're going to see hair-raising numbers on the CPI as we get into March, April, and May. I did a very simple kind of back of the envelope calculation. And if the CPI just goes up by 0.3% each month between now and May, the headline CPI year on year will be 3.9 by May. I mean, where are we? 1.4 today?
Wow.
Yeah. If we go up 0.4 a month for each of those months, the headline CPI will be 4.4%. So these are numbers that no one is really starting to wrap their heads around. If we get anywhere close to that, the comment that you made about treasury yields backing up, I mean, we're at 1.3 now and the headline CPI is 1.4% year on year. Where will that treasury yield be if we see numbers that are 2.5, 3.5? I presume they'll be substantially higher. And that creates a major risk for the stock market because, as we talked about, it's life-threatening to a huge swath of corporate America. And these pie-in-the-sky earnings estimates, for sure, are going to have to come down dramatically in an environment where companies are having to service much higher interest-bearing debt. So that would be one concern.
All right. So as I do every week, I'm after we let you go here, Stephanie, and we're coming up on that time. You've given us so much for your time already. Thank you so much. This has been one of my favorite discussions so far of the entire year. So thank you.
I'm just glad you didn't throw yourself out the window yet. I take that as
well, same to you as well, because I think we should have our opinions here. But the guys at New Harbor Financial, they are financial planners who see the world through the same lens that you and I do. And they are helping people try to make sense of all this. So and those are the types of people who are watching this video. So, what do you, what do you recommend, or what do you advise people to sort of consider looking at in terms of preparing for this type of future that we're talking about? So it certainly sounds like you think, look, the probability of a material market correction is at least high enough that you really got to factor that into your portfolio strategy. So I guess probably do you think just get out of the markets, or just reduce your equity exposure, or whatever? And then secondly, are there certain sectors, are there certain asset classes that you think will fare better than others, in the next year or two, given some of these macro dynamics that we've been talking about?
Well, I guess from an absolute return standpoint, I would say you want to be out of the market. Just because I anticipate that, yes, there'll be some sectors that ultimately will outperform, but we'll have a risk off situation where exposures will be taken down across the board. And that will hit everything from, US stocks to Bitcoin to gold to emerging markets. We'll just see a general reduction in exposures. Obviously, we have hedge funds and pensions, and everyone have employed massive amounts of leverage to hold these positions. So as they take that leverage down, it'll be like an air pocket. Everything will just reset at a lower level. And then you can go in and try to pick out which sectors might outperform. And when it comes to that time, when the dust settles on that first leg down, I would be looking to pick up some cheap emerging market opportunities. They're both on the credit side and on the equity side. I'm bullish on gold. I hold gold as, I will call it, a core position in my portfolio. And obviously, I wish it were doing better now. It's getting kind of lost in this tug of war with Bitcoin for some reason. But I still like something that I can touch and feel and know that it's limited in quantity and it's not going anywhere. So I get the warm and fuzzies from that. And it'll sound crazy to say it, but I would also be long treasuries with the understanding that in the near term, you could get smacked around a little bit on this inflation scare. But ultimately, because of all the reasons I described from the demographics and the debt, I think the path of least resistance for interest rates in the US in the treasury market is still lower, not higher. We just can't handle any increase in rates here without snuffing out the economy. So George Soros had this theory of reflexivity, where a market, like, for example, people will talk about the cure for higher oil prices is higher oil prices. And it's the same with interest rates, especially in our levered economy. The higher interest rates go, the quicker they're going to come back down because you just snuff out any embers of economic activity so quickly on an economy that's toting as much leverage as we are. So I'd like treasuries. I like gold. I wouldn't be totally averse to sitting on cash and waiting on the sidelines for opportunities like the ones I mentioned when the dust settles on the risk off.
Okay, that's wonderful. Thank you for sharing that. And I'm chuckling here because I already owe you a gift bottle of wine for starting this interview without the record button on. But now I think the guys from New Harbor, who I'm going to have on in just a moment, owe you something even bigger, because you hadn't met them before we started recording this video. But what you just outlined there is essentially the New Harbor portfolio, which I think is so funny. So I think they're doing backflips, getting ready to come on the program here. So
good.
Thank you so much for giving us such wonderful insights, such articulate answers to these really important questions, and for doing the back and forth dance with me for the past year and trying to get you on the program, giving the dance card. So thank you so much.
It's my pleasure. Without trying to sound ghoulish, I've actually had a lot of fun. So thank you very much.
Well, look, for the other people who have really enjoyed hearing you as well, where can they go to learn more about you and your work?
Great, thank you. They can visit my website, macromavens.com. I also do a periodic podcast with Grant Williams, who I know you're familiar with, and that's not surprising given our Seinfeld interest, called the Super Terrific Happy Hour, which we do once every few weeks. So those are two ways that they can follow me. I wouldn't advertise Twitter because I almost never post anything there, but you can check out in case I might have a random moment of weakness. But primarily, I would just go to the website and you can see a lot there.
Great. Okay. Well, we'll put up the URLs for all of those when we edit this video. And yes, just a real plug for the podcast. We are huge fans of Grant. He has been on Peak Prosperity an awful lot. Stephanie, I hope you want to start competing with him for a number of appearances on our program here.
All right. If I can beat him at anything, I will take that opportunity.
All right. But I sort of think of it as the Reese's peanut butter cup of podcasts, which is two great things that taste even better together. The chocolate, the peanut butter, Grant, Stephanie. If you like that analogy, go listen to him. It really is wonderful. Stephanie, thank you so much. You gave us way more time than I expected. I feel embarrassed by that, but very grateful. So thank you. And we'll let you go now, but we will have you on again, hopefully later on in 2021, when maybe some of the things we talked about have come into a little bit clearer picture.
Right. Then I really will have a margarita.
Okay.
Thanks so much, Adam.
Thanks so much, everybody. Take care. All right. And now, John, Mike, boy, it just seems the guests just keep getting better and better and better. What a phenomenal interview Stephanie is.
Yeah, we really enjoyed that, Adam. Thank you. That was a fantastic conversation with Stephanie, and she had a very articulate response to your question about deflation versus inflation. We too think that deflation is still a clear and present risk. In fact, maybe the 0 to 2 years time frame, deflation is what is probably more likely, and then past that 2 years plus, inflation probably comes on stronger after major intervention by central banks. And it was nice of her to talk about her investment outlook. And yes, I mean, we clearly think the same thing, not because there's any collusion or we talked about things ahead of time. I think we're just seeing the same data, a hyper overvalued stock market, and a market that essentially on the first leg down will probably take 10, 15, 20% drop suddenly. And there's really no way to avoid that if you're in it. So you have to position yourself defensively and then start picking amongst what looks attractive later on, which is essentially what we're doing.
Yeah, and it was shocking to me just knowing your guys' allocation, which you've shared on this program many times. But she basically said, "Hey, look, risk of a market downturn is so great. I would be as out of the market as you can be. Being in cash is a plenty good place to be. You guys are largely out of the market. You have heavy cash reserves at the moment." She talked about a core position in gold, which is, I would say, your biggest long position right now in your portfolio. Again, guys, correct me if I'm wrong in any of this, but you're heavy in gold and in the gold miners. And then she talked about emerging markets. You guys do have some emerging market exposure. And she talked about treasuries. That's maybe the one point of differential. I think she was talking maybe longer treasuries because she thinks rates will come down, where you guys are using short-term treasury bills really as a way to hold cash. But, it's still in the treasury family. So anyways, yes, you guys owe her a very, very nice thank you for that, because she just set the ball up way, perfectly on the tee for you guys to come on here. One thing that I want to just highlight, and John, I'll let you build on this, but this is where, I think this is why I have you guys on the program every week. It's so hard for people to look at the headlines, talk to the man on the street, see that Bitcoin has, jumped above $50,000, see that the major stock indices are back at all-time highs, whatever, and feel like, when I think about this, when I look at the data, I realize that yes, risk is very high and I should be conservative because it seems indeed that the odds of a potential large correction are unacceptably high at this point. Then you go out in the world, you kind of listen to what you're being told, and you feel like, wait a minute, the party is passing me by and I'm the guy who's missing all the fun, right? And that feeling of FOMO, fear of missing out, really kicks in. This is when an advisor is so critically important. This is, I think, when you guys really earn your fee, where you are keeping people from following the siren song, getting overly invested, too far out on the risk curve, and being at unacceptable risk if and when that correction does happen. And that's when people lose 20, 30, 50% of their portfolios in these corrections, right? So I want to congratulate you guys on doing the hard work, because I know it is not easy. I know that people don't, actively thank you for, kind of having to be the adult at the party. But I do know, because I've seen it many times when corrections have happened, they are immensely, incredibly grateful afterwards for not being involved in the collateral damage that all their friends who were long the market get caught up in. So John, look, I'll let you respond to that, but I really just wanted to spell out that this is when guys like you earn your stripes?
Yeah, thanks, Adam. It is incredibly hard for all the reasons you've articulated. Now, yeah, I really love the way Stephanie put it. She's not a doom and gloom perma bear. She's just looking at the data and commenting on it as she sees it. That's really what we view our role to be. And it is hard. And thankfully, we get lots of feedback from our clients. We get lots of very helpful and thankful notes from our clients saying, we really appreciate you all, kind of really putting your necks out there, so to speak, to really try hard to see the truth and speak openly and candidly, even if it's a lonely voice. And that's ultimately the best way we know how to return the trust our clients place in us, to return it with a pledge to do our very best to speak confidently, openly, objectively, humbly about the data that we see.
All right, great. Well, Mike, so I'm just trying to think of things that are notable to talk about that have happened in the markets in the past week. I'll hand you the torch to talk about whatever you want, but just picking on a couple of things that Stephanie and I had mentioned. One is that interest rates still seem to be creeping up, and we talked a little bit about that with Stephanie in terms of how that can be a real game changer if it continues to go higher. Just curious if you guys have an opinion on that. And then secondly, she mentioned you're sort of seeing Bitcoin's spotlight kind of overshadowing the precious metals here. Precious metals are weakening a bit. Silver is kind of hanging in there at 27, but gold's now down, in the 1700s. So it's come down a bit. Whereas Bitcoin, has just been a house on fire and just recently cracked above the $50,000 a coin mark. And just for perspective, guys, we had Alex Saunders, the Bitcoin expert, on this program back in the fall. And I think back then Bitcoin was maybe like $12,000. So, it's seen, a 4x increase in just whatever that was, 6 months ago or so. So, there's that definitely is still going on. Is it a mania or not? Still, jury's still out on that. But if you guys have any comments about the whole Bitcoin versus gold issue as well.
Yeah, with Bitcoin, it's difficult for long-term believers in gold and silver to watch gold particularly not participate in what Bitcoin is now participating in over the last couple of months. It's like the gold bugs have held metals for so long, and they were expecting central banks to go crazy and create this runaway inflation. And now it looks like it's actually playing out, but only in Bitcoin, and is leaving the precious metal holders out. Well, we're not convinced yet, to be honest, that cryptocurrencies, Bitcoin in particular, are the end all be all. We're seeing a lot of speculative activity and panic buying in that space. You know what I mean? And we're not sure whether Bitcoin and cryptos in general are one of many nested bubbles. We're seeing bubbles everywhere. Are they one of many bubbles, or are they really an alternative to these bubbles? It's difficult to say. The blockchain is brilliant technology, but a lot of energy goes into mining, and a lot of energy is wasted. You've got thousands of supercomputers all performing the same calculations, trying to win the mining fee, and only the one that gets it done gets rewarded, and all the other energy is wasted. I don't know. We still prefer, we're not discounting cryptos. Obviously, these things have based out and broken out to new highs. So the charts do look legitimate, but we still prefer gold and silver for long-term holders. It makes more sense. It's easier to understand. We prefer holding it in our hands, just like Stephanie mentioned earlier. So, gold has pulled off a little bit from its high, and it seems to be sitting on a support shelf right now at around 1765. It's a major support shelf. Silver has held in better than gold, and frankly, it looks like gold probably wants to take another leg lower to shake out weak hands at this point. We hate to say it, but it's sitting there, and that commodity is notoriously volatile, and it's hard to imagine that support shelf doesn't get broken, at least for a very short-term flush. So we're very mindful of that. And yes, we do have a pretty decent sized position in gold mining stocks. And so we're continuing to monitor our hedges. We just yesterday refreshed our hedge on our mining shares, and essentially right at this level, or maybe just a couple percent below. So we really don't have any or much additional risk below these levels. We don't like to see this multi-month pullback in mining shares, but honestly, no major technical damage has been done, and we're still long-term believers. At the same time, we do expect deflationary impulse downwards, maybe a rapid drop in the S&P, and we have to be mindful of what can happen to gold mining shares if that happened. Much like last March, when gold miners GDX, for instance, went from 30 to 16 in a week and a half. The puts that we had on during that time helped us get through that. So, yeah, disappointing that gold's sitting out of this. We think it's a chance to accumulate more for people that don't feel like they have enough or have any, particularly on a further drop to maybe 1680 or 1720 on the downside in gold. And miners, we're going to hold them with the tight hedges. Not a lot more exciting happened in the market in the last week. The yields do continue to go up there. Not a lot of people are noticing yet, but 1.3 on the 10-year, it's going to start putting pressure on this. There is no alternative narrative. There is an alternative if bonds start to yield something. VIX is stubbornly sitting in there at 22, 23, month after month after month. It's signaling that something else is coming. And other than that, we continue to adjust some hedges on some of our positions. We're only about 10% net in the stock market right now. Our biggest exposure is in energy stocks, and we started to move some of the option hedges around to give us a little more upside in oil and to refresh the hedges in gold miners, like I just said. So I think I'll stop there and see if John has anything else to add.
No, I think I guess the one little thing I'd point out, and I think might have already been touched on, the commodities across the board. We're talking energy commodities, base metals, agricultural commodities, lumber just hit a record. There are parabolic moves in the commodities. You look at a chart of oil, and lately, of course, it's been affected by the chaos that's going on in Texas with the winter weather and the shutdowns of refineries and things like that. But who would have thought that back in March, spot oil prices went negative, meaning people were willing to pay for folks to take oil off their hands because there was no place to store it. And here we are, crude futures are $60 a barrel, right? We've had an amazingly sharp move higher from where we were in March, and a lot of the commodities look like that. And whether it's a pickup in spending, inflation, whatever, it's pretty eye-popping in the charts.
Yeah, and just a reminder for folks, when we interviewed oil specialist Art Berman about 2 months ago, he talked about his predictions for higher oil prices starting around mid-2021 because of supply shortages. And so what's happening right now is really happening even before the factors that Art was warning about. So, if you think the recovery up to $60 a barrel is extreme, we might have another surprise coming for us in just a couple of months during the summer. All right, guys. Well, in closing up here, Mike, just to build on some of your comments there on gold. One, precious metals, gold in particular, they are more sensitive than other commodities to interest rate increases. Gold, sort of they say the thesis, one of the big theses for owning gold is that it's attractive when you have negative real rates. And, mathematically, when the nominal rates begin rising, the real rate in theory will be increasing as well. So maybe that's part of the factor here. A little too early to make any strong conclusions there, I think. But you talked about your guys' strategy of using options to limit risk in your portfolios. And I think that's something that is so important. We've talked about it on past videos here, but for folks that aren't aware of it or just aren't that familiar with it, if you prioritize capital preservation, which is sort of what we hear a lot from the people that watch these videos, then employing strategies that still allow you to preserve a good quality of the upside in the positions that you're holding in a market like this, but really give you downside protections, are really, really worth considering when market risk is as high as it is today. So if your current financial professional knows how to use that stuff, definitely talk to them about what might be appropriate for your portfolio. But if you do not have experience yourself in that, or you don't have a financial advisor who knows how to deploy those well or has experience with them, gosh, you should talk to guys like the guys here at New Harbor. It's a very, very smart, prudent way to protect capital in a high risk market like this. Okay, guys, so before we get to the last closing comments, I just want to put up a chart here for a second. And this is of SPACs. And for folks that aren't familiar with SPACs, it's just kind of this new craze that's going on right now. It's sort of a way to kind of circumvent the IPO process. So it lets you bring a company public, which basically means it goes from being owned by private hands to owned by public hands, but without having to go through all of the regulatory and disclosure hurdles and heavy work that's in there for a reason that companies normally have to go through when they're going public. And you typically only see things like this happen in markets where people are throwing caution to the wind. And anyways, these SPACs are vehicles where a private company can go public a lot faster, and they're just exploding, as this chart shows. We're setting new records almost every month now over the past year, and it's for now shows no signs of slowing down. But John, I see you nodding here. I just want to see if you guys have any commentary to add to the whole SPAC craze at the moment.
Yeah, well, that's a kind of a flashy kind of warning sign. So, when you look at bubbles, invariably they involve extreme valuations and stuff like that. But what they also involve, and what usually signifies the late stages and almost the end stage of a bubble, is when you start seeing these almost in your face, ultra sensational things making it to the headline news. And even the SPACs themselves, they're coming up with names like, I worked at Enron way back in the early part of this century, and most people know where Enron went, and they had these toxic off-balance sheet vehicles that were named after Star Wars, themes, right? So kind of cute names, but what they weren't cute at all. They were actually toxic, company and economy destroying things. The SPACs are in the same kind of phenomena right now. There was a SPAC named after the Queen's Gambit, the popular, I forget what network series, maybe Netflix or something.
Netflix,
like yeah. There was one that just came out. I think the name was Just Another SPAC. Like almost like you folks are so stupid that you're going to give us this money. We're going to name it something absurd, and you're still going to give it. This is the kind of stuff you see at really idiotic late stages bubbles. That's about all I have to say about that.
All right, that's really all I was looking for. It's yet another signal of the runaway exuberance, overconfidence, hubris, whatever you want to call it, of this market. And again, folks, that's all we're trying to do with these weekly videos is just keep track of what the data is telling us, what the signs on our dashboards are telling us, and they continue to blink bright red warning signs for us that this frothy market cannot continue at the rate and at the heights that it's at. And that there is going to be some sort of corrective event coming at some point. And we're not the only ones saying this. You've heard all the experts that we brought on for the past bunch of months, and you're seeing a lot of legendary investors, everyone from Buffett to Grantham to Carl Icahn to just an incredibly long list of very storied long-term investors who seem to share this opinion too. So all we're trying to do is make sure that if you're out there trying to build wealth and invest your capital wisely, that you have an accurate assessment of what the market risks and opportunities are. All right, guys, so in wrapping things up here, I'll try to do this in less than a minute. Folks, if you're watching, if you have not yet subscribed to this channel, please take a second and do so. It's right down there below the like button. Click the subscribe button and the little bell next to it. That way you'll get alerted the next time that we do one of these videos. While you're down there, hit that like button too. It does make a difference in terms of how frequently the YouTube algorithms will surface videos like this for other people to watch, and we think it's important they hear this message. If you want to find out who our upcoming guests are on this program or suggest guests that you'd like to see, follow me at Menlo Bear on Twitter. That's my handle there. And I'm on that feed almost daily, listen to comments people make. So it's the best way to make your voice heard. And then lastly, as I alluded to earlier, if you have not yet made yourself available of the completely free, completely no strings attached, free financial consultations that John and Mike and the team at New Harbor offer to investors, you really should strongly consider getting that one now, especially given everything that Stephanie was talking about earlier. Again, real quick, these are completely free. There's no obligation to work with these guys. They do this as a public service to the Peak Prosperity audience because we have sent them so many people just like you over the years who are just trying to find a prudent way to take care of their wealth and trying to make sense of a crazy market. And folks, this is the craziest market that John, Mike, myself have ever seen. You heard Stephanie say it earlier that she's ever seen, and we've heard that echoed by all our previous guest experts. So if you want to figure out how to set up a free consultation with them, it only takes a couple of seconds. Stick around to the end of the video. We tell you how. And John and Mike, thanks again for yet another really good week. Great guest, great discussion, great insights on your guys' end. And no matter what happens next, we will be here to track it together, and I will see you guys next week.
All right, thanks, Adam. I think it might be time to take some of Stephanie's advice and put it into action. She mentioned something about margaritas, so that's where we should all go.
Wise words from a wise lady.
Absolutely. Thank you, Adam. It was fun. Enjoyed it.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.